Jump into it. I really appreciate you. This is episode 6 of the Droppin Knowledge podcast. I created this this is a quarantine project, right? I created this probably 2.5 weeks ago. I'm one that always likes to do as much as I can to share the information, pass the information. I thought about you, obviously, given that you just helped me get into this home that I'm broadcasting from today, and it was such a seamless and easy process. You were super knowledgeable, and I know that that's a question that I get quite often, being that I'm in the financial literacy and credit restoration business. People usually want to buy a home, right? And so I thought that it would be great if you could give some background, even maybe prior to them getting into the process, so they understand what's kind of ahead of them. So,
okay.
So again, appreciate you. But before we get started, why don't you let the audience know how long you have been in this lending business, and just some of your background. Okay.
So a little bit about me. I'm Michelle. I've been in the mortgage industry since actually 2003. So my mom had a brokerage. She had a broker shop. I was their receptionist there, and then their processor. I was in college at the time. So been in the industry for a long time, saw how things progressed, during the recession, and then stayed in the industry. But I was more a support role. So branched off on my own into origination in 2014. So I've seen a lot that's happened in the market because of the years that I've had, which has helped a lot in terms of helping clients and understanding the process of navigating the lending side of things, because it's not just qualification, it's also paperwork. It's a lot of paperwork, especially now. Yeah. So, I specialize with first-time buyers. That's just been my specialty. I do specialty loans like renovation loans as well. But that's been my focus. And then my mom, who I worked with before, works with me now. So she's on my team as well as my brother. So it's a little bit of a family affair.
It is. It's a great team. Great team. I mean, super seamless and easy. So if I'm in the market, let's say I'm looking to buy a home for the first time, what are those things from a financial perspective? Let's put finding the dream home to the side. But from a financial perspective, what are those things that I should be thinking about?
So I always say that if anyone's interested in buying in the next year, start the process now of getting pre-qualified. So actually have your credit checked by a lender, have them look over your income situation and determine the qualifying income, look over the liabilities that you currently have and figure out what the lender would allow for in terms of a new mortgage. The earlier you start the process, the more information you have, the better prepared you'll be. And then there's no scrambling and trying to make things work or, try to pay something off to just fit that box. So number one is starting the process as early on as possible, getting informed. Got it.
Good. So is there because I understand what you said, is there a tool or something that can start to scare people, right? Liabilities, this, that. You just may feel like I don't have a handle on things in that way. And of course you should, but is there, and it may not be, but is there anything out there, a tool that you've heard of, something that can help someone just kind of put their financial life together to even prepare?
So there are some tools. So there are some homebuyer classes out there that offer some worksheets, and I don't have the exact webpage to share right now at this moment, but I can definitely add that into the comments later. Honestly, creating a spreadsheet with income and expenses that are fixed and that are variable is going to be a great start. Just creating your own spreadsheet, figuring out what do you currently spend on food? What do you spend on shopping, on, vacations, on just everything, necessities, insurance, medications, like all that. Right. So starting from scratch, what are all your current expenses to have a better understanding of where your money is going? Because a lot of people don't know where the money is going. I couldn't tell you offhand exactly where it goes. I have an idea, but you really have to just get organized and have everything kind of separated to make sure that that you're always paying yourself. And then of course, when you're looking into investing into real estate, that there is going to be enough money to pay that new expense as well as maintain your current lifestyle.
Got it. Okay. Mm-hmm. What do you think about if I'm looking to buy a place, and obviously I'm probably renting now, right? If I'm going to be a homeowner or I'm looking to buy a place, should I look at it just kind of, I'm paying $1,000 for rent, okay, great. I should be able to pay $1,000 for mortgage. Should I think about it that way? Or should I be thinking, no, I actually need to be paying, or I need to have more income, right? Or I need to direct more to that payment because buying a home has other expenses. How do you look at that, or how do you think about that?
So that's a great question. And it really is going to be a personal question for the individual. Oftentimes when I have the first conversation with someone, I ask them specifically, have you thought over what your budget would be for this new housing payment? And if they haven't, they'll say, well, I know that right now I'm paying, X amount of dollars per month, so I know I can handle that. And that's kind of like our baseline.
Right.
But to your point, there are other expenses. There's maintenance, right? Now you're a homeowner, you don't have a landlord to call to make repairs. So how do we handle that? Well, I don't know all the expenses that someone may have. So it's hard for me to tell them, okay, well, unless I knew the excess funds that they had, it's hard for me to tell them, well, you should really stay under this budget because I looked over your worksheet and I see that there's nothing left over. So it really is going to be a personal choice. And so that's why it's so important for individuals to have all of their own expenses kind of set aside in a spreadsheet. They know where their money is going. They know what's left over at the end of the month, and that can help them determine, okay, after my mortgage, will I have extra money to set aside for those upcoming maintenance? Because you're going to have maintenance, whether it's now or later. There's always going to be maintenance involved when you own a property. Right. So it really is going to be up to the individual to make that decision, because even though I can assist, I don't know all of their expenses.
Right. Yeah, that makes perfect sense.
Mm-hmm.
So what about the word credit, right? We're getting ready to get a place, and I know my credit's going to be a big factor. Is it the score? Is it what items are on my credit? Can I still buy a place with some negative items on my credit? Do I have to have it completely clean?
Mm-hmm.
Kind of talk about that a little bit in terms of what your credit needs to look like to be able to buy a home.
That's an excellent question. There are many factors involved with credit. We are looking at a minimum credit score just to initiate the eligibility, determining the eligibility of the applicant. But outside of that minimum credit score, we are looking at the overall credit history. Okay. So let's say someone had a previous hardship and they had to file for bankruptcy, for example. Mm-hmm. There's a waiting period after a bankruptcy to be able to obtain a mortgage. Let's say that someone has had collections. Do you necessarily have to pay off all those collections to qualify for a mortgage? Not necessarily, but it's a combination of all the factors. So let's say, everything looks good except for one collection, and it's a minor collection and it's a couple years old. That may not impact you. Right. Okay. If there are several open collections that are non-medical, in addition to late payments, in addition to a previous bankruptcy, now that changes things a lot. So from a lending standpoint, we're looking at reducing risk. And when we're looking at an applicant's credit profile and there are negative marks, that's not a reason to necessarily decline the loan, but we have to make sense of it. Did something happen before that you've recovered from? So, now we can explain why there were late payments, but we can see you've been paying things on time. And so that old account, that old collection doesn't take a part in disqualifying you at this time. So it is everything that we're looking at. Right. So there's no one answer to that question. Sure. It's the whole profile.
It's the whole profile.
It is the whole profile, but it's trends. So again, if there was a hardship and you've recovered from that and you're paying things on time,
right,
we can make it work.
Gotcha. Okay. So let's talk about that. I think it's at least whether it's right or wrong, you'll be able to confirm or not. But I hear that to buy a place, you need to have at least a minimum of a 580, mm-hmm. right? And so is that correct?
That's accurate for the most part. So let's talk about loan types. Yep. So generally speaking, we're considering just traditional financing. And we're also talking about low down payment. So 3.5%, 3% mm-hmm. down.
Yep.
580 is the minimum credit score. Yes.
Okay.
There are, two basic loan types. It's either going to be conventional financing or government financing.
Okay.
The government financing is usually, it's going to be either FHA, the most common, or for veterans, there's VA financing.
Right.
And for the government financing, 580 is the minimum for those loans.
Okay.
However, for FHA specifically, FHA will allow a credit score down to 500 with a larger down payment.
Okay.
In that case, there have to be compensating factors for that credit score.
Okay.
So, but generally speaking, 580 is the score that we're looking for with that low down payment option, because in many cases, that 10% down is hard to have with that credit score. So many cases, people are looking for a lower down payment option. So we're looking for that 580 FICO.
Gotcha. Okay. So let's talk about FHA, right? I know that that's a first time kind of home buying loan, and I think it needs to. What's the period? You can do more than one FHA, but there has to be a certain period of time. Is that correct?
So you can have you can only have one FHA loan at a time.
At a time, right?
Unless there's like 3 reasons why you could have more than one FHA loan at a time. One might be you're relocating over 100 miles. So if you were moving from out of state and you had an FHA loan back home and you're coming to Illinois now, you can use FHA again if it's over a 100-mile move. But so the FHA loan is for a primary residence. And if you have one, if you use it for your first loan, for your first property, and you want to move out of that property and buy another property, you would have to sell that property to then use it again.
Okay.
Or if you weren't going to sell it, you can rent it, and then use a conventional loan for your second property. So you can't have 2 FHA at the same time unless you meet the rules. As I mentioned, the relocation is one, and there's a few others depending on, if you were a co-signer or if your family size has increased, and we can prove that. And again, I think there's a distance requirement as well. I'd have to double check it, but typically 1 FHA loan at a time.
Gotcha. Okay. So with FHA, so if you at least qualify, so at least you have a 580 or so, does your credit score matter after that? Is it the same rate? Does it impact anything else having a higher credit score versus a lower credit score once you have hit the minimum of a 580 score?
Great question. So yes, it does. In the mortgage world, the underwriting is automated. So even if you meet that minimum credit score, and let's say your debts are within a certain threshold, meeting general guidelines, we still have to submit it through this automated system. And the automated system has to approve it. And what I found is that any credit score actually under 640, there are extra requirements. Like the debt to income ratio is a little bit stricter.
Got it.
And then to your point, yes, it does affect cost. If the credit score is below 640, that rate's going to also be higher because, it's an added risk. So it does impact qualification in terms of cost and also how much debt you can carry with this new mortgage.
Got it. So it doesn't impact the money down. So it's still 3.5%.
It could potentially be. So it depends. If it's a 580 credit score, we might need 5% to get it approved to be at a certain threshold level. So it's all about reducing risk.
Right.
And so from a lending standpoint, credit scores under 640 are fair. 640 to 680 are good. 680 and up are going into your excellent, right? Mm-hmm. So if we have fair credit, minimum down, and the debt to income ratio, scenario is up to 50%, that's too many risks. So It's not going to approve it. Right. But maybe if we do a larger down payment with a 580 score, then maybe the automated system would approve it. That debt to income ratio, though, is always going to be stricter with that lower credit score.
Got it. Okay. That makes sense. So DTI, debt to income, that's a term that you'll use, and that's an important term when looking to buy a home or a property. Can you kind of explain what debt to income is and what sounds pretty, self-explanatory, but can you kind of expound on it a bit?
Yes. So we're looking at, from a lending standpoint, we're looking at the qualifying income, which if you're salaried, it's going to be your salary amount before taxes. So it's going to be gross income. If you are self-employed, we're going to look at the taxable income from your taxes in many cases, and that's going to be your qualifying income. Then we're going to compare what your obligations are on your credit report. So it's going to be the minimum payments on credit cards, the obligated payment on installment loans, and there may be other debts that are included, like if you owe money to the IRS, for example, then we have to consider that debt, or any other court-ordered debts. So we're taking all of those monthly obligations plus the new proposed mortgage payment and dividing that by the income. So we have to be at a certain threshold. So typically, the debts compared to that gross income should be, for sure, if we have to throw one number out there, I would say under 50%. It may be stricter.
Okay.
On some programs, it may be more flexible on others. So generally speaking, all of your debts on your credit report, and again, court-ordered debts, plus your new housing payment have to be within 50% of your gross income.
Gotcha. Okay. So you're with Cross Country, right? What's the difference between, if I'm looking to buy a place, I bank at Chase, and I'm like, hey, Chase actually does home loans. Let me just go to Chase. What's the difference between going to a Chase and maybe going to a loan officer or so that has different programs and different banks, et cetera? What's the differences, and why should one look at, why should you look at one versus the other?
I love that question. So at Cross Country, we're a correspondent lender. So all we do are mortgages. That's it. I'm a mortgage specialist. I don't do anything else. We don't sell personal lines. We don't sell credit cards, checking accounts, savings accounts. So what does that mean to the client? Well, because that's all we do, we focus on getting all the products that are on the market available to our clients. Also, from a level of customer service, because this is all that I do, this is all that I focus on, the service may be a little bit different. Now, I'm not going to knock retail banks, because there are some great lenders out there that are retail banks. But the difference is, again, that they have other lines of business. So their focus may be different. Maybe they don't have all the programs that we have, because, there are other lines of business. So they don't necessarily have to seek every single mortgage product that's out there. Right. So the difference for a consumer would be, well, what's the service going to be like working with someone that may have other lines of business? And then what are the products going to be like? And those are the two questions that you'd want to ask. So it's good to talk to more than one lender to understand the differences. And ultimately, who you choose to work with, it's going to be like, we work together. It's a close relationship. There's a lot of information that transpires throughout a real estate transaction. So you want to be comfortable and knowing that that person is going to have all of the products that you need to service you. Got it.
Absolutely. So my mortgage payment, right? When I pay my rent, it's just one number. I know what it is. That's just what I pay to rent. But a mortgage has, or mortgage or your monthly payment has different elements in it, right? Can you kind of talk about everything that's rolled into that number?
There are 4 pieces to your housing payment from a lending standpoint, because we're not considering any utilities that you may have, but what we are considering is the payment on the loan itself, that's your principal and interest payments, the interest on the loan, the property taxes associated to your property, the insurance as well. And insurance, so there's actually potentially 2 different types of insurance. There's homeowners insurance. Everyone needs homeowners insurance to protect the property in the event something happens to the property.
Right.
And then if you're putting less than 20% down, or if you're getting an FHA loan, you're also paying insurance for the lender. And that protects the lender in the event of default. So that insurance policy is part of your monthly mortgage payment. And then, of course, if we're talking about different property types and there's a condo, there might be an assessment fee for the condo.
Sure.
Which adds element number 5. So, there's a lot of pieces to it. And so when we're talking housing payment, it is going to always be inclusive of taxes, insurance, and everything related to the loan. So that's your loan interest payment, and then mortgage insurance if you have mortgage insurance.
Got it. So you mentioned PMI, or private mortgage insurance, as potentially a part of that monthly payment. I know that there's different loans where it's kind of on there for the life of the loan. Others, it goes away after a certain period of time. When and where does that happen?
Great questions. So insurance for the FHA specifically, if you're putting less than 10% down on the FHA, that insurance is going to be a part of that payment for the term. So if you have a 30-year loan and you keep that 30-year loan, you're going to always pay that insurance as part of your monthly mortgage obligation. If you put, let's say, 10% down again on or less than 10% down again on the conventional loan, at a point you can cancel that insurance, and that point would be 80%. So once your loan balance is down to 80% of the original purchase price. So let's do the numbers. Let's say it's a $100,000 purchase. You put down 3%, your loan balance is $97,000 to start. Once that $97,000 loan balance goes down to 80%, you can cancel that insurance, and it no longer is a requirement. If you do not reach out to the lender to cancel, they will continue to take payments from you, because by law, they can collect payments until that loan balance is down to 78%.
Okay.
So that's $78,000. So they'll keep collecting those checks from you. So it's important to know that, because if you don't reach out, you'll just pay a little bit more out of pocket.
Got it. Okay. I think we have a question from someone. So can you be considered being a first-time home buyer after a certain period of time? That question's from Pat Coe.
Yes, Pat, great question. So actually, you are considered a first-time buyer after 3 years have passed since your name was on title of a property. So if it's been 3 years, you are again considered a first-time home buyer.
Got it. Has anything changed, right? In the last, 45, 60 days or so since this pandemic's kind of happened, how's that impacted the lending world?
So couple things have changed. One of the big changes are related to appraisals. So we can now allow exterior only appraisals. So the appraiser doesn't have to go into a property, can be a drive-by. They'll pull data from, public record as to other sales in the area. Honestly, most of my transactions have still completed regular appraisals where they're able to go into the home. Because I have had agents ask, well, how is that going to impact value if they're not going in and seeing the improvements?
Right.
There's a possibility that it may, and we may see that if this continues for a long period of time, and then we have to get more exterior only reports on purchases. But so far, no changes, just because my transactions have been able to, my appraisers have been able to go into the property. But that's one change. If someone is unable to get into the property, seller's not comfortable, or whatever the case is, that's okay. We can still proceed, get an appraisal done with a drive-by. The other major change has been related to income. So a lot of people have been laid off because of the situation, and that really changes things, right? You get everything together, you prepared for a year, your credit's good, you're in the process, and then there's a pandemic, and your employer says we have to shut down right now. So what's happened with that is that if anyone has been laid off, if their employer can guarantee that their job is secure, they can return, and their employer also confirms a return date.
Okay.
And then our borrower says, we're going to go back to work. Yes, we intend to. Employer says, yes, it's okay. Here's the return date. We're okay to proceed and process that transaction, close as planned.
Okay.
If the employer doesn't know when they're going to reopen, then we are in a holding pattern, because we really don't know when our borrower is going to receive their regular pay.
Right.
And so that's going to be a risk to the lender.
Got it. Okay. Good information. So nothing with the credit score. It seems like, sometimes you hear information in the street. And so I've heard that there's been an increase in credit score requirements. Is that true?
So that's excellent. I can't speak to all lenders, right? Okay. I can only speak to what's happening at Cross Country Mortgage. It is true that lenders are tightening up on guidelines to reduce the risk. So there may be lenders that have increased their credit score requirements, while others have not. Okay. It may be that they require extra reserves to make up for lower credit scores. So that's going to be specific to every lender. Right. And I would say anyone that's thinking about buying, that that may have already talked to a lender. Let's say we have an audience here that someone's gone through the process or pre-approved. Right. Double check with your loan officer that nothing has affected your qualification, because you do want to know that. Anyone new to the process, you may get different information from different banks. So again, a reason to talk to more than one bank, because your qualification may be different now with these extra guidelines that have been implemented for certain types of loans.
Gotcha. Okay. Let's talk about, we talked about FHA, we talked about conventional, even my own personal situation, right? We were doing FHA, but one property was okay with, the other property wasn't okay with, and it had to do with purchase price. Kind of talk about, and that kind of forced me to go conventional. Yeah. So talk about those requirements for folks that might be looking, and where FHA kind of the maximum ceiling is, and so forth.
So, we can actually go twofold on this. So one of them is limitation on loan size. So there are different loan limits for the two programs. And so that may or may not be an influence to the program that you decide to choose. Ultimately, when you go through the pre-approval process, you first want to learn, what do you qualify for? If you qualify for both programs, then you want to understand what's the difference in limitation for both, because there will be differences. Right. So loan size is one. Another big factor is the property type. Now, condos require an extra level of review, generally speaking. They always have. FHA this year loosened their guidelines, where they allow us to approve a condo for financing specific to our transaction, whereas in the past, the whole condo project had to already be FHA approved. And so instead of reviewing the whole project, we're just reviewing the unit. So that gives us flexibility, because we can control that approval process. What I've seen in the market this year so far is that it's hard to get an offer accepted if the listing agent doesn't know the new FHA rules. They're just not comfortable with it. Right. Two, we have to still go through the process of collecting all the data needed to approve it for FHA. And it may or may not, and we don't know until we collect all the paperwork. So that could be very different with the conventional that maybe has 10% down payment. They have less rules. It may be easier to get it approved with that loan type. So those are the kind of things to consider when you're comparing FHA and conventional specific to condos. Like, what are the guidelines for the condo, and how is this going to impact the inventory available to me or any offers that I submit?
Got it. Okay. I know we have a couple of questions here. I want to ask you one more follow-up question. I know that, again, given that I'm just recently went through this process, and this is a little bit more probably next level, but we had a scenario where we were able to buy down the interest rate. And I don't mind if you use my example, if you remember. I know you do a lot of business, but you're able to buy that down. And so what does that mean, buying down an interest rate? What's the advantage of it? How are you able to do that? And does it cost me anything, basically?
Okay. So buying down an interest rate is always an option. And for many first-time buyers, it's not something that we necessarily have a conversation about, because interest rates, generally speaking, are low. There's different factors that influence pricing. So if, for example, we're looking at a low down payment option, and maybe we're looking at a condo, which from a lending standpoint is a higher risk loan, those things are going to affect pricing. And if you were in a position to be able to lower your interest rate, lower your monthly payments, and one, increase equity faster because you have a lower interest rate, and two, you have the liquidity to do this, in the long run, it's going to save you a ton of money. If you have the seller paying some of your closing costs, that would be something that you can also use to buy down this rate. So it's going to be an individualized review to see what makes sense and what doesn't make sense. But the option's always there, and it is going to be something that's going to cost money up front. So you got to be careful in understanding, okay, how much is it going to cost me? When am I going to see the savings? And how long am I going to save in the long run? So we also have to have an understanding of what's your short-term goal and your long-term goal. If this is a short-term home, it may not make sense to buy down the rate because you're only going to be there for a few years. But if this is going to be a 10-year home, you could be saving thousands of dollars. Right. So those are the kind of things to consider when considering buying down the interest rate. Got it.
Great. Let's jump into a couple questions. So Jessie had a question. How do you determine how much you can be pre-approved for?
So, hi, Jessie. So to determine how much you can be pre-approved for, talking to a loan officer as myself is gonna be very helpful because we can share with you the guidelines. What I always, say in regards to that question is also how much do you want to be approved for in terms of housing payment, because that's going to make a big difference. A lot of times you might qualify for more than what you want to receive from the lender. So let's say the lender says, yeah, no problem. You qualify for a $350,000 loan. Your payment's going to be X amount of dollars per month, but you only want to be, within less than $2,000. If you want to be less than $2,000 a month, you don't want a $350,000 loan. So it's really important to know what your personal budget is. And so that's always the number one step. Number one step is always figuring out what is your personal budget, how much can you comfortably spend on this purchase? And then with that information, talking to a lender and see how that translates to a loan.
Excellent response and great information. So must have come in from one of my other pages, but what should my minimum income be with a 680 FICO score with no collections or bad debt?
Okay, so outside of so we talked about debt to income ratio, right? Yeah. That's all of your obligations in the new housing payment. There's another calculation that the lender uses, and it's the housing ratio. So we're looking at the housing expense compared to the income. And the guideline for that, and this is the guideline because it varies depending on the loan program, but generally speaking, if you have no other debts, you can have a housing payment of around, let's say 45% of your gross income. So to answer that, it's hard to give you, how much should your income be exactly. It depends on, how much of a loan are you looking for? And right. and you might be a self-employed borrower, maybe, I don't know, but my self-employed borrowers tend to ask this a lot because nobody wants to pay a lot of money to the IRS. I mean, let's be frank, and when you're writing off a lot, you are reducing your income, which is reducing your purchasing power. So I do get asked this question. So, I'd have to have a better understanding of how much are you looking to spend, how much of a house are you looking to buy, what is that loan size, and then let's work the numbers backwards, and then I can give you that minimum monthly payment.
Excellent. So again, anybody watching this, if you're just jumping on late, make sure you watch this entire thing. This is some of the best information that you can get about the buying process. And again, I didn't want just Michelle on here because of her knowledge, but I actually had personal experience, right? She helped me close on my place within the last couple of months, and her team are amazing. And so she will be extremely helpful through the process. And this was, I think, my 6th purchase of a home, and it has never been this easy and never been this seamless, and work really well together. So highly recommend her. If anyone on this live is actually checking it out, just search her, right? Drop something in my comments. We're friends on Facebook, and she'll follow up with you. So another question. So anything on the low end, like the 640 she was referring to, might require higher down payments. What is looked at on your credit as far as debt to income ratio? So I'm assuming they're talking about well, I'll let you handle it. It's pretty tough.
So under 640, you may still be able to purchase with 3.5% down. Your debt to income ratio just has to be within a certain threshold. What's looked at as far as, what's included in that debt to income ratio is the minimum obligations on credit cards, the minimum obligation on installment loans, so car loans or student loans. Actually, student loans is a tricky one because we may have to use a percentage of the outstanding balance. So it's hard to give you an exact answer, but I would say just generally, you may still be able to buy with 3.5% under 640. We have to evaluate your scenario specifically to see what is currently outstanding to give you a better idea of what your purchasing power may be with your current credit score. And I do want to add, if anyone has, if they need help with credit, obviously they can reach you, Knowledge.
Yes.
Yes. So, but, we'll always work together. I mean, ultimately, the goal is to always have a consultation initially. First, understand what your personal budget is. Let's have a conversation and we'll put a plan together. because you may not be ready right now. You might not even be planning until next year. But going through that process of pre-qualification process is going to help you better understand what the lender is looking for. And then you can put a plan together with myself or with Knowledge to make sure that you get there in a timely fashion according to your personal goals.
Absolutely. So some really good questions. I've got another question here. So can you have a personal loan for your home and a loan for a business property?
So, I mean, you would get a residential loan to purchase your home. And then there are business loans. There are commercial loans for a business property. And so depending on the property type is going to determine the loan product. So residential loans, just as an FYI, would be your condo, single family, townhome, and then a building up to 4 units. If the building is greater than 4 units, if it's five or more units, it's going to require a commercial loan. Or if it's just business property, business space, it's going to require a commercial loan. So you could have a loan for both. There's different requirements for both. I only specialize with the residential.
Got it. Very good. Thank you. I think we kind of touched on this, how the student loans affect the FHA loan. This
is a little different. So for student loans and FHA specifically, we are looking at the balance of the student loans, and we're using 1% of the balance in your monthly obligations, whether or not you're paying that now, because FHA just has a conservative guideline on student loans. So in some cases, conventional is more flexible with regards to student loans. And so that's why we want to compare the two programs to see what the purchasing power is between the two. So there's a big difference there with student loans.
So how does the purchasing process change, Michelle, if I'm looking at maybe not just a single family or a condo? I may be wanting to do a multi-unit building, right? A 2 or a 3 unit. How does that change things?
It changes things a lot in some aspects. So when we're qualifying for a building, there's rental income, right? So we're going to consider the rental income the property generates. And we're taking a percentage of it. We're not going to consider it 100% because there's always a chance of vacancy. Right. When we're looking specifically at 3 to 4 units on the FHA loan, we do need more reserve because it's a higher risk. And so extra assets are needed. We need to verify more money. And that's not money to be used at closing. That's just money that's available for our applicant to have, access to if they needed it. So at minimum, we're looking at 3 months of mortgage payments in reserves on a 3 to 4 unit purchase. And then the building also has to pretty much pay for itself. There's a self-sufficiency test that we have to run a calculation and basically just make sure that after our vacancy factor, the mortgage payment doesn't exceed the rents that the building generates. So those are the 2 extra rules for 3 to 4 units. But overall, when we're looking at qualification, the credit scores and everything still apply, but we may need more money on the 3 to 4 unit purchases. Got it. And I had to do my own homework on self-sufficiency tests. I was Googling it because I know we ran into that when I was looking for multi-unit properties. So how long does this home buying process take? What's kind of an average period that I can look from maybe the time that I first contact you to the time that I'm in my place or I'm at the closing table? So generally speaking, so it all depends on when you get under contract, right? Your loan process, once you have a contract, it can be completed in 4 weeks. So you could be from beginning to end, let's say 5 weeks, generally speaking, you could be in your place. If you start the pre-approval process now, you get your pre-approval within a couple of days, you start shopping, that could take a couple weeks, that could take a couple months. So that's going to really affect your timeline. But once you do have that contract, you're usually closing within 4 to 5 weeks from signing that contract. Got it. Excellent. I think we're getting ready to wrap here. This has been amazing information. I'm so appreciative again that you come on this Saturday morning. Hopefully those folks that have jumped in have taken a lot of information and insight from you. Any final thoughts that you seem to kind of run across that people can help themselves if they would have kind of known or had some information prior to getting to you? Are there kind of 1 or 2 tips
that you can kind of share with the audience?
Prior to speaking with me, definitely creating your budget. That's super important. No lender can really tell you how much to be spending. I mean, again, they can give you guidelines, but you ultimately need to know what is going to be a comfortable payment for you, your family, to be able to, spend the money on this house and continue your lifestyle. So definitely prepare a budget. And know how much you have available for down payment, whether it's, and you can start this process even before you have the full down payment. That's okay. Because a lot of times people don't know how much they need. So that's totally fine. So just getting an understanding of, how much you can put together, what's your monthly savings ability if you don't have the savings right now, because that helps us figure out a timeline. So doing that kind of legwork up front is going to help you better, because then we can put a timeline together for you. Got it.
Well, great. Again, I appreciate you taking time out. I know it wasn't the easiest with everything going on your side and just everything going on in general. And I know you stay super, super busy. So I really appreciate the time. For anybody watching, absolutely, if you're in that process, you're thinking about buying a home, I give her the highest recommendation. I was just extremely happy and satisfied with the process. If you're not where you need to be from a credit perspective, obviously I'm in the financial literacy and credit restoration business. Reach out to me. We will get you right. We will get you set up and ready so that we can get you into your place. And this podcast will actually be on all streaming platforms on the Droppin Knowledge podcast. So Apple, Spotify, whatever you use, it'll be up within the next 48 hours. And so feel free to share it with a friend, someone, is interested in buying or purchasing. I think this is tremendous information. You're going to be in a much better position getting ready to buy, listening to this prior to the process. So thank you again, Michelle.
Thanks for having me.
Absolutely. Stay safe. And I'll talk to you soon, because I'm sure I'll be back out in the market soon.
Sounds good.
All right. Take care.
Take care.